Good afternoon, everyone. Welcome to Questrade's webinar series. Thank you so much for joining us. My name is John, and I'm your host from the Questrade Education team. And joining me shortly are our very special guests and presenters. But before we get started, let's quickly go through some important notes for the event, along with a quick disclaimer. So today's session will be recorded, and we'll have the on-demand version available next week. If you have to leave early or would like to rewatch an important section, we've got you covered. Keep an eye on your email inbox for the recording, and we'll also have it posted to our YouTube channel. If you have any questions during the presentation, please type them into the Q&A window available at the bottom of the Zoom interface. That's the Q&A window and not the chat window. Our agents can help answer simple questions throughout the presentation, and we'll be hosting 2 longer question and answer periods during the webinar today. If you're having technical issues or have general questions about Questrade or trading, please feel free to message our Questrade agents via chat. And here's our quick disclaimer. Don't worry, I'm not going to read the whole thing. Please remember that the information conveyed in this webinar is for informational and educational purposes only and does not constitute advice or recommendations by Questrade. All right, so moving on, here's our agenda. We'll start with a quick introduction of our speakers today, and we'll be joined by Jessica Inskip from OptionsPlay to start us off, and she'll walk us through income investing using options. The first session will last approximately 40 to 45 minutes, and we'll wrap up with our first live Q&A period. Right around the halfway mark, we'll have a short break or intermission, so feel free to get up, stretch, or grab some water before the second half of the event. The second part of the webinar today will be presented by Tony Zhang from OptionsPlay, and he'll discuss how to use the new OptionsPlay platform that's built right into Questrade Edge, and how OptionsPlay generates trade ideas, and much more. Lastly, we'll wrap up with another live question and answer period to help close out today's event. Now, without further ado, I'd like to introduce our first guest speaker today. Jessica is the Director of Product and Education at OptionsPlay and has been a prominent figure in the online brokerage industry for the last 13 plus years. She specializes in options and derivatives, and her main passion is investor education. We're very excited to have Jessica here today. So without further ado, I'd love to pass things off for part 1 of our presentation. Thanks again, and take it away.
Thank you so much, Jonathan, and welcome everybody. Really excited for today's session. And like Jonathan said, today we're going to focus on income investing, and I'm going to make sure we talk about covered calls and cash secured puts, which is the income side of options. And thank you again for that wonderful introduction. We do have a quick disclaimer as well from the OptionsPlay side. Know that largely this is an educational, informative presentation. It's used purely for demonstration purposes only and educational purposes only, not intended to be individual tax, legal, or investment planning advice. Any examples, they're not including any commissions or fees, and we're a third party that is not associated with Questrade. All right. And if you've never attended an OptionsPlay session, we love to start them out with what our OptionsPlay Education is all about, which is empowering you to trade sustainably and confidently. At OptionsPlay, we believe the foundation of options trading or even investing in the market begins with a solid foundation. So we want you to know that that's the purpose. The best investment that you can really make is in your education. So we commend you for attending today's session and happy to do this with Questrade. So what are we going to talk about today? So first of all, we're going to break down options pricing, how they're comprised. That's the foundation of options. If you've never been introduced to options before, we always start with breaking down options pricing because that helps you understand the positive and negative factors that are on your side. We add a layer of complexity when we add options. We need to break down what that layer is because the price is derived from more than just the underlying security. We'll go through understanding covered calls and cash secured put, as that's the crux of the strategy we're going to walk you through today, which is creating the wheel strategy. And then of course, Jonathan will come back on and we'll have some Q&A at the end. So let's go ahead and dive in. First of all, when we are looking at an option or we have an anatomy of an option, it's really a contractual obligation between a buyer and a seller. The buyer owns the rights of that contract and therefore can execute upon those rights, whereas the seller has the obligation to fulfill those terms. And if it sounds like a lot of legal jargon, It is, because it is a contract between a buyer and a seller. But if you have that mindset, it can help add some clarity of the anatomy of an option. So we ask ourselves, what quantity are we agreeing on? That represents one contract generally represents 100 shares. What product? That's the underlying security. In this example, we have ABC stock, but know that can also be an index, even futures. There's so much that options are traded off of, and even commodities. The price, so that's always as represented by a per share basis. So we have $100, so $100 per share. And then the time frame, we're adding that layer of complexity because the option does expire at some point, and it's only good for the duration of that contract. Once that expiration period is met and that market closed, then the option ceases to exist. And that's important to know. And that's how we go into the positive and negative factors of options, and how we can utilize the positive and negative factors with that understanding to decide optimal entry and exit points as well, which Tony will go further into. That option is issued as a call or a put. A call just means it contains the right to buy. That's something, terminology, that I'd love you to think about. Anytime you hear the word call, I want you to think the right to buy. Anytime you hear long or purchase, that means you've purchased the right to buy. Put, the right to sell. Short, you've sold the right to sell. Or long, you've purchased the right to sell. So keep that terminology in your mind when you're reading these types of contracts and dealing with options. The option can be exercised. So that means you execute upon the terms of the contract. Once more, only the buyer has that right to exercise upon the terms. They're the driver in the situation, is the analogy we love to use. It can expire. Again, if that option reaches its expiration date, it's going to cease to exist and no longer is trading. Or it can be traded on the secondary market, which is the most common. Fun stat: about 70% of options are actually traded. The remainder will expire or exercise. And remember, expiring may be your goal. That may be your goal of the option. And it certainly is when we're talking about short options. But the option is traded on the secondary market for a premium. And the premium is what comprises the options price. But just to put this all together, in this example, we're looking at one ABC 100, September 8th, 30 days until expiration. Let's pretend that's 30 days from now. That means this contract represents, if it was a call, the right to buy 100 shares of ABC stock at $100 per share at any time through the expiration period. If I purchase that call, I have the right, I can exercise upon that terms of that contract. If I sold that call, I'm obligated to fulfill that terms, which means sell the shares. If I purchase this as a put, then I have the right to sell. If I sold the put, then I have the obligation to buy. You take on the other side. And we'll put that all together if that was extremely confusing. We've got a lot of tools and resources. But before we do that, I want to focus on how an option is priced, that premium component. Now, the options price, we call that the premium, synonymous terms. That's comprised of two main components: intrinsic value and extrinsic value. Intrinsic value really means, does this have executable value? From a terminology perspective, we call an option that has executable value in the money, because it's got some monetary value associated with it, all in the name. For example, if a call moves above the strike price, because a call represents the right to buy. So in that previous example, if we've got ABC, the right to buy it at $100 per share, and ABC is at 105 per share. Well, if I have the right to buy at 100 and I can immediately sell at the market at 105, that has to be worth at least $5 per share. It's in the money by $5 per share, because that's the executable value. And extrinsic value is comprised of two main components, which is time value. The more time you have until expiration, the more expensive the option's going to be. And that's because the more time you have for it to have value, there's the logic associated with it. As the option nears expiration, it actually loses this time value because it's a decaying asset. And that's important to know when we think about positive and negative factors if we're buying or selling. And the third main component, second of extrinsic, is implied volatility. It's a very extremely important component of an options premium. A great example is anticipated earnings announcements, or even any type of announcements now we think about this current market environment. But for example purposes, earnings is just a wonderful one. You can even pull an option chain and see spiked implied volatility around that time. So for earnings, when we have the underlying security, we know there's a specified report date. When that's announced, we know that when they're going to report, there's an analyst consensus, and then the stock is either going to miss or beat earnings. There's conference calls, revenue expectations, but we know that an event is going to occur, and we know the stock normally moves up or down drastically depending on that report. Because of that likelihood of the market's anticipated movement of the underlying security, implied volatility spikes or increases, and that makes the option more expensive. And what you'll notice about the extrinsic value components, they get more expensive or less expensive due to the likelihood of it actually having intrinsic value or being in the money. That's the way I like to think about the way options are priced. It's important to know dividends and interest rates are also a component of an options premium, but these are the three main components that we're going to talk about today. The way that I love to keep this in my mind, little alliteration, is intrinsic value really means internal factors that affect the options price. So such as this is derived from the underlying security, hence the name derivative. And the extrinsic value is external factors that affect the options price. And so those are like time and implied volatility and announcements, items that are really out of our control. So let's talk about premium decay, because that's really important to think about. I touched on it for one brief moment, but when we're talking about selling options, this is where we need to think about the positive and negative factors. So we know the time value, implied volatility, internal factors, and external factors. What this means is these are decaying factors, that extrinsic value. So as the option nears expiration, it's only worth its executable value. So this is going to deplete right when we get to expiration, meaning the component of the option, the value that it's normally generally worth on that day of expiration is its executable value. This is completely gone. This is what weighs the most. And if that's important to know as we're trading options, because if we're buying options, we are largely directional. We want the option to go up in value as much as possible. We want it to be in the money because we own the rights to execute upon those terms. Whereas when we're selling options, we receive that premium up front. So naturally, if we're selling up front, we want to buy lower, which means time works in the favor of the option seller because it's naturally decaying, whereas it's a negative factor for the options purchaser. And we're going to focus on option selling today. And it's important to know those positive and negative factors that affect the option, because that's the way that we're going to determine our entry and exit points and those optimal strategies that Tony will go further into when we go through the practical application. Now, I know I threw a lot there. That was really a foundational options 101 very, very quickly, but I always like to end the 101 portion of any presentation with this slide. And if you've never seen this slide before, I'm happy to walk you through it. Actually learned about this one when I first got my Series 7 over a decade ago. But nonetheless, the calls are on the left-hand side and puts are on the right-hand side. You'll notice that there is bullish strategies found at the top and bearish strategies found at the bottom, and they are color coded for a reason. So long calls are purchased for a premium. They represent the right to buy an underlying. The goal is for you to have the stock rally more than the premium that you paid. So it profits from a sharp upwards movement, which means time decay is negative, that time component we were talking about. You notice on the opposite end, long puts, it's just the opposite. We're switching the name from call to put. So remember earlier when I said, when you hear the word long, I want you to think purchased or bought. I've purchased for a premium. I've purchased the right to sell the underlying. So the difference here, same mechanics, is just the direction at this moment. And the beauty of this chart is you can flip you can utilize it as everything is essentially a mirror. So short puts and short calls have one thing in common, which is that selling for a premium and the obligation that's associated with it. So multiple items in common. Your goal is for the option to expire. That's when you realize your maximum profit potential, but that means time decay is positive because that's a decaying factor that occurs within your option. But what you'll notice, and this is what I want you to focus in as we move on to the next session, is the goal is you are profiting from a neutral to a slight directional bias. When you're short a call, it's the inverse over here from the long call, because remember, we're taking the other side. So we are profiting from individually a downward movement, but the short put is an upwards movement, and that's individually. But we're going to pair them together, which means we're going to throw a wrench in all of it, but I'll put it together for you. Now, moving on, whenever we're trading options, we tend to be on two buckets, is what we like to call it. Either A, you're seeking income, which is what we're going to focus on today, or B, gaining directionally. I want to make sure you had some exposure to that as well. Just some examples of the seeking income would be covered calls, cash covered puts, credit spreads, things of that. Gaining directional are purchased options. So you notice the difference there. Sold options, generally seeking income. Gaining directionally, those are purchased options. And your goals are neutral with a slight directional bias. Your ideal outcome for the individual option, when we add a stock in there, it varies, is for it to decrease in value, whereas we gain directionally, you want it to increase in value. And I always like to begin the sessions with the logic of options because it helps wrap around any type of new strategy that you're introduced to, because they are incredibly logical as they are derived from the underlying security. We're just adding that complexity, which is an expiration date, and that premium is comprised of more than just the movement of the underlying security. All right, so let's move into the wheel strategy. Now, this has become a popular strategy in terms of the name. However, it's been around for quite some time. The intent of it is creating continuous income, allowing you to purchase the stock at a discount, but still participating in capital appreciation. And what's important to know when we're talking about options is there's always a give and a take, which we'll go through a lot deeper. Meaning if something seems to be too good to be true, there is always, if you're receiving premium, you're giving up upwards potential. So keep that in mind, and I'll discuss it in those terms. And we'll bring this up. I always like to start with this lovely graphic of what the wheel strategy is, but we'll bring it up throughout and really put it through together. So the crux of the rest of this presentation is focusing on what the wheel strategy is. So how it starts is essentially it's a wheel. You start here by selling a put. And remember, when we sell options, we collect an upfront premium. There are two outcomes of that option if you do not close it out. Either A, it's going to be expired, in which case you realize your maximum profit potential and it is removed from your account. You keep that upfront premium. That's the end of that trade. Or B, you can be assigned, which can occur at any time, which means you buy the security. And what the thought is with the wheel strategy is if you're looking to utilize options and utilize the obligation that's found within options, which in this case, when selling a put, is the obligation to buy, you're doing it with that intent. So you are setting cash aside with the intent to buy a stock, much like a limit order, but of course, definitely varying as we have the complexity of options. So the intent is you sell the put continuously until you're assigned. And that's the way that you reduce your capital expense, because you're actually receiving upfront income by selling that put. Once you're assigned, you're then obligated to buy that stock. You own that stock reduced by the amount of premium that's received through this continuous cycle of selling the put. That's the way that we purchase the stock at a discount, because it means you are receiving continuous income or reducing your risk exposure. Once you're assigned, now we own the stock. And when that occurs, that creates a covered call if we were to sell a call. So we're utilizing the obligation of the call side. And we're going to specify a sell price utilizing that strike price. You collect a premium, and we do this continuously until we're assigned. And then once we're assigned, we sell the stock. And this is called the wheel because it's just a continuous movement that occurs when you want to buy and sell stock. The give and take, again, the give is you're receiving continuous income. The take is capital appreciation. We're participating in capital appreciation, but you're going to cap your capital appreciation, the directional exposure that you have. And we'll go deeper into that, but it's important to know the risks involved when you're trading options and all of the mechanics of it. If this seemed like a lot, do not worry. We're going to break it down. We've got some great examples that we'll cover further. So let's talk about a covered call individually. We'll go into the cash secured put. So to create a covered call, first of all, we need to own 100 shares of an optionable stock or ETF. And remember, when we own a stock, the goal is for it to go up in value as much as possible, which means this is a bullish strategy. That is the most common question we get when we're talking about managing covered calls, cash secured puts, or the wheel strategy altogether is, what do I do if it moves adversely? So I like to begin with answering that question right away. This is a bullish strategy because you own stock. The intent is to own stock. And when you own stock, you want it to go up in value as much as possible, but you're neutral and have a slight directional bias. So you're neutral short-term, bullish long-term. That's important to know. Hence why we started with the pricing mechanics. So to create that covered call, we own the 100 shares of an optional stock or ETF. You sell a call, that stock then becomes collateral, because if we sell a call, that means we sold the right to buy. Since we sold the right to buy, we are obligated to sell. So that's where that comes in. The stock is that collateral. We're attaching it saying, I have these shares available to sell. That's the way it becomes covered, because you're covering your obligation by owning something already. And you receive a premium in exchange for that obligation to sell the stock at a specified price. And that's where we need to account for specific capital appreciation when we own the stock, something Tony will go deeper into. But I do love to show the profit and loss diagrams, give you a brief overview of what this means. It's a great visual of, one, this represents the stock price going up in value. So I know that this has capped upwards potential purely by looking at this profit and loss diagram. My max gain is achieved if the stock rallies to the strike price. And as it moves above the strike price, that's how I have my capped upwards potential. Will not gain any more because I have an obligation to sell, in which case that is very likely to kick in. You break even right here, which is if it moves the premium, and you still retain your substantial loss potential because you own the underlying security. So the most that you can lose when you buy a stock, speaking of cash accounts, is the amount that you spend, right? And you still retain that amount, but it's reduced by the premium that you receive. So this dotted line represents the stock, can go down, you can go all the way to zero, but the stock has unlimited gain potential because it theoretically can go to an infinite price, but you are capping your upwards potential by selecting that strike price and selling the call, but you're reducing your break even by the premium that you receive right here. That's what this represents. So let's go to a cash secured put. So now I love explaining those profit and loss diagrams, and then you'll see here, it's a similar picture. We just don't have the underlying security because this too is a bullish strategy. Now, in order to sell a cash secured put, this is on the buy side now. You have to have the cash readily available to buy that stock. So remember, one contract represents 100 shares. So you need to have the cash available to buy that 100 shares. You then sell a put option. You're utilizing that cash as collateral and receive that upfront premium in exchange for that obligation created to buy the stock at a specified price. So same substantial loss potential because you are obligated to buy that stock. That normally occurs when the trade moves adversely, which in this case would be down. And so that's very important to know. But your max gain is only limited to the premium that's received. So that's the difference between your break even and this max gain is the premium amount. So the stock, that's how you reduce your risk exposure. If we were comparing this to buying the stock at its current price and selling in at the money, which is a option with a strike price that is equivalent to the market price. But again, we're starting complex and we're going to break it down even further. So if you're lost, that's okay. So let me give you an example of a stock trader and your risk versus reward. At OptionsPlay, that's how we focus, is risk versus reward. As investors, that's important. As traders, that's important. We have got an example here of ABC Security. Let's say you're bullish on ABC Security. You perhaps would specify a buy limit order at 50. And that could be, it's at 72 cents lower than this current market price. When you do that, you're going to create a limit order, which is going to utilize your cash as collateral. And you can't do anything else with that cash unless you cancel that order. So think about the mechanics of options, what we discussed, and the same thing there. Perhaps once that's executed, you may have an exit strategy with the sell limit at 58. And once you own that, you want to go ahead and sell that stock at 58, utilizing your shares as collateral through that limit order that you specify. In that scenario, you're risking $5,000 to make $800. You have an entry point, perhaps that's off of some type of technical analysis of some sort, as we've laid out here, and you have an exit point in mind. And that's what's important to understand. A lot of times when we're discussing trading, we talk about entering into a trade and having that entry strategy, but what even is equally as important, in my opinion, is the exit strategy as well, which is what we'll discuss utilizing the wheel strategy. So we're going to start right now with going here. So selling the put, going through utilizing the put to purchase the stock, and then we'll move on to the call. So we'll bring this up throughout. Now I've got an example here. We're going through 60 days and we're going to utilize ABC stock. And I'm going to do it with the eyes of that stock investor versus the stock and options investor. And remember, there's a give and a take when you're trading options versus stock only. The stock investor and the stock and options investor, both starting with $5,000 worth of cash. The stock investor who wants to purchase ABC will put in that buy limit order of 100 shares of ABC at a $50 limit. They are debited $5,000, the transaction of that account. The options investor is going to sell a cash secured put. In this example, it's a $50 strike, so that at the money strike, and they're collecting $3.15 of premium. So they're credited $3.15 of premium. So the stocks break even is 50 because that's the amount that they spent. Whereas now the stock and options investor, they've reduced their premium by the amount that was credited, $3.15 to $46.85. The stock investor owns 100 shares of ABC worth $5,000 right now. It's $50 a share. The stock and options investor has utilized that $5,000 for collateral, has added $315 to their account, but has created an obligation through the short option contract to buy 100 shares of ABC at 50. Same intent, different execution here. Now, let's see what happens as we move on for 30 days. And we're assuming these are 30 days out. Very important to note. This went up in value, which means it's expires worthless. That's the intent of it, right? Because remember, the option contains the right to sell, the obligation to buy. So if it goes up in value, it's better than the market. Therefore, that option expires worthless. The stock investor, they collected 2% because it's now $51. So they've made $100 altogether. The options investor has collected 6%, $315, but they do not own the stock. Very important to know, the stock investor has voting rights. The stock and options investor does not at this point because they do not own the stock. Now, the options investor will then again, now that it's moved up, sell another at the money option. So 51 strike, another 30 days out. That's at the money. And notice when you see this price changes based off of day one from $50 per share. So now they've reduced their option break even more by another $3 to $44.85. So they've received another $300. And now there is $5,100 of their cash as collateral. And you can see the pattern here, created another obligation to buy ABC now at $51 per share. Now let's say ABC moves back down to $50. Now the stock investor, they are break even. The options investor is assigned because the right to sell at 51 is more favorable than the market price of 50. At expiration, they will be assigned. They're debited that collateral that they set aside. They still keep that upfront premium. And you'll see that they are not break even. They have collected premium. Therefore, they're up net cash wise because of the obligation that they created. So that's the difference here. I do like to stop here for one moment and talk about the give and take, because if you've never seen something like this before, you'd say, oh, why doesn't everyone do this? Well, that's where it talks about optimal strategies, and Tony will go deeper into this in the next session. But the give is that premium that you're receiving. The take is upwards potential. If ABC in the previous example, or even in this example, if this was at $60 per share, you would have been better off buying the stock because of that large movement higher, meaning you can only collect the premium that you receive. So if the stock rallies more than the premium, the stock investor will make more. That's why you're neutral to bullish. So hopefully that helps add some clarity as to why we say this is your directional bias when you're selling options. So let's move on. We talked about selling the put. It expired one time. We sold another one. We were assigned on the second. So now we own the stock, which means we've got to move on to the next component of the strategy, which is selling a call and participating in capital appreciation. So the stock investor, they're going to put their limit order in, remember, at that predefined sell price, which is $58. So they're going to sell 100 ABC at a $58 limit. Their collateral is the stock that's attached to that limit order. You can't do anything else with that stock while that limit order exists. The stock and options investor is going to sell a call. And you notice that we've moved the strike prices around. We're accounting for capital appreciation now, assuming this is 30 days out. But from July 1st, this 55, we're allowing for $5 worth of capital appreciation, collecting a premium of 2. So creating an obligation to sell this stock at $55 per share, receiving $200, adding to my cash amount. Both the stock and options investor own 100 shares of ABC. At this time, the stock and options investor, everyone here has voting rights. Important to talk about those differences. Now, if ABC rallies to 52, we've accounted for capital appreciation. That's what's important to take note here. The stock and options investor has realized that, or it's unrealized, but they have capitalized on that capital appreciation, and the stock investor has as well. They participated in capital appreciation. Did not reach our strike price of 52, or excuse me, of 55. It reached 52. Therefore, that option expired worthless. That upfront premium is retained fully, and we sell another call, create another obligation. Let's say we keep the 55. Something's coming up, however you're feeling in your sentiment, you can roll up, down, out. There's so much that you can do. The sell limit order still exists for the stock investor. We're on day 92 for the stock and options and stock investor. Now they're selling another 30 days out, about 30 days, a 55 strike, and collecting another $2. So that's $200 worth of premium. So you can see how we're adding to our cash position, and we've now created an obligation utilizing those shares as collateral. But the break even now, we're down to 40.85 for the stock and options investor versus the stock only investor. But you also notice a lot more management required for the stock and options side. Now, let's say, again, the give and take. ABC does make it to 60. It rallied. There was earnings. Something happened. And ABC is now up 20% from when we started this. The stock and options investor, they're going to be assigned, they're required to sell at that 55. That obligation exists as long as the option contract is open. They'll still receive that credit at 55, but they still keep all that upfront premium, this credits that's been accrued this entire time as that upfront premium when we sell those options. And then the limit order, because remember, this is a limit order for the stock and only investor, kicked in to sell at 58. If they canceled that limit order, they would have participated in that additional capital appreciation. It's important to know there. They've made $5,800 and we've collected, or we sold for $5,500, but we keep that $915 in premium. So altogether, the stock and options investor in this case made 28%, whereas the stock only investor made 16%. Both still extremely healthy gains, but you'll notice the neutral to directional bias, which is very important to consider when you are trading this type of strategy. If you have something that you expect to move really, really high, that may not necessarily be suitable for this type of strategy, because you would end up making more being the stock only investor, because the give is the premium that you receive for stock and options. The take is the capped capital appreciation. You still participate in it, but that's why it's important to understand how to select optimal strike prices and optimal expirations, which again is the next session. So hopefully that put together the intent of the wheel strategy. We sell a put, either it expires or is signed. That's how we have our continuous income, is through the continuous selling of options. If we're still bullish on that stock, that allows us to purchase the stock at a discount because we're reducing our risk exposure by receiving that income. And we're participating in capital appreciation because we're owning that stock and selecting a strike price that allows us to participate in capital appreciation once we own that stock. I feel like that it breezed really quickly through that, but we can go through and have questions from here.
Fantastic. Thank you so much, Jessica. We really, really appreciate the first part of the presentation. I'm happy we got through everything, and I know I learned a lot about the wheel strategy. There's going to be some things that I'm going to be incorporating in my trading strategy. So hopefully the audience was able to learn quite a lot too. Right before we kick off the Q&A, I'm just going to take the audience quickly through how to enable options trading in your Questrade account. If you haven't done so already, if you're new to options, or maybe if you just opened your account. Perfect. Let me get this up on screen here. And while I'm showing this off, I'm also going to launch a quick poll just as a knowledge check, just to see how much maybe we've learned during the first part of the presentation before we hand things off to Tony in about 15 minutes here. So just how comfortable are you with options trading? So hopefully most of you guys aren't selecting the first option. So feel free to throw up your selection here. As for enabling options trading in your Questrade account, it's very straightforward. All you're going to need to do is log in and click the account management menu, then account management once again. Select the little pencil icon next to your option level. Now remember, this is per account. So if you have a margin account, a TFSA, and an RSP, for example, you will have to set your options levels per account. You also may need to complete and sign an options trading agreement if you haven't done so already, and trading will be enabled within 1 to 2 business days. So hopefully that helps out. And let me just check back in here on our poll before we jump into the Q&A. Awesome. I think I'm going to close things off. Wow, we got almost 100% participation here. 52% participation. New to options, but know the basics. And then we've got some people who are a little bit more familiar and more comfortable. Fantastic. Thank you, everyone. Awesome. So for our Q&A here, I'd love to welcome Adam from the studio if he's available, and Jessica back as well. And let me pop open our panel here. Thank you again for all the questions, and keep them coming. So the first one I'll tackle right here from the get-go is, will a recording be available? Yes. So if you missed the section of the webinar, or if you're tuning into the second half, you got to leave for a meeting, we will have the recording available next week, sometime around Wednesday, Thursday. So keep an eye on your email inbox and our YouTube channel for that. Perfect. Let me see if I can find another great question here, maybe for Jessica, and then I'll hand things off to Adam to read another one. So maybe a bit of a general question here, Jessica, for you, from someone in the audience. I make pretty good money by going long and short stocks and ETFs, but I'm new to options. How long would it take to get as good as I am at trading stocks with options? Should I trade just what I know, or maybe take the next step? What do you think? Maybe a bit of a personal question here.
Oh, I love that question and happy to answer it. So with any time that you're trading or investing in the market, and yeah, this is my personal answer, I always have a hard time calling myself an expert, which is something that I need to get over. But that's because there's always something to learn. Market dynamics shift, and it's constant learning. So that's really your personal view of that. Am I as good as I am elsewhere? That I think you could address, but it really is being confident in the decision-making process, which starts with understanding how options are comprised and having the right tools and resources. That's really what's essential to that. And that's what builds that confidence in making sure that you're making those okay decisions. But more importantly, is having a very disciplined approach. I'm sure the reason why you are successful in trading stocks and ETFs is because you have a disciplined approach and you take that emotion out of options. You can, or excuse me, out of trading the stocks. You need to do the same thing with options, is that disciplined approach and taking emotions out. That's extremely important. And then if you've really done a great job with that with stocks and ETFs, the psychology of it is really what's important when trading in general. And if you've already mastered that, I really think you're a step ahead. And if you're taking the time to learn today, perhaps you have that same mindset where you say, I need to learn everything as possible before I can make a confident decision. But the beauty of it is it's the right tools and resources. And I think you'd love Tony's session that will go through some optimal entry and exit points and helps you make those decisions and gives you the right information. So that would be the next step, is looking at the right information. But we've built a tool with Questrade that will walk you through, that will explain that further. So a bit of a long answer, but hopefully that answered your question.
I think it definitely does. Thank you so much, Jessica. I know I'm really excited for the second part as well, the more hands-on part of the presentation, but the theory was fantastic and really good kind of recap, even for those of us that are maybe a little bit more advanced. And I can definitely echo the discipline part of your answer there. I've made one too many mistakes being hot-headed with trading. And if you try to take those emotions out, usually those always lead to better outcomes long-term. So kind of same approach, just moving it up another level to options. Okay, let's see. We've got a lot of questions rolling in. Thank you again. Adam, do you see any in here that maybe you want to tackle or maybe you want to read out?
So thanks, John. Right now, we just had a quick power went out and came back on. So I have to kind of jump back into finding some of those questions. So I might hand it off to maybe you or Jessica just for a second, and we can jump back to me in a moment.
No problem. All right, maybe I can answer one here quickly. And that's going to be about some of the commissions for options trading at Questrade. This has come up a few times, and I know some of my colleagues have answered this as well. So generally speaking, if you're not an active trader, if you're just starting out, options trading is $9.95 and $1 per contract, and that's for each buy and for each sell. However, if you're here at the session, if you're interested in getting into options and you're planning on trading them regularly, I would highly recommend exploring our active trader options. You can check out our main website. Let me quickly actually just show this off here. And the pricing will come down significantly. So if you're an active trader, I highly recommend getting on one of our active trader programs, since you can either choose from a fixed or variable option, which brings it down to $4.95 or 75 cents a contract, or $6.95 and 75 cents a contract. So doing lots of cash secured puts, lots of covered calls. This may be something to consider.
I see a question I'm happy to grab here. So
Sure.
As an example there, I buy a call option, example 55 with an 11 limit, and the option expires below the strike price. What am I on the hook for, and what happens if it is above the strike price? So when you buy the option, you're in the driver's seat. You are the one that is hitting the gas, hitting the brakes, deciding if you go left or right, meaning it's your decision if you want to execute upon the terms of that contract or not. Your decision, because you're buying, and it's a call, which means you're bullish. If it goes above the strike price, that decision becomes more favorable, but you don't want to give up that extrinsic value, which is any time value that's there. Meaning, if you are choosing to exercise that option, you need to compare if you're giving up any premium that you could get on the secondary market. That's why most people tend to not exercise those options unless there's other circumstances, the way that your account accounts it. But to answer your question very directly, because you own the right to exercise that contract, what you're on the hook for is the amount that you spent, because you're not obligated to do anything. It's entirely up to you. Now, the way the OCC settles those options for US style options is if it is a penny or more in the money on day of expiration, it will auto exercise. And that's because it auto exercises so you don't lose that value. Otherwise, it expire worthless and you have some value because it has executable value. So that could be perceived as you being on the hook, as in you could overbuy your account. There's a lot that could happen there. So that's why it's important to monitor them. But it's also why we say holding an option until expiration equates to risk. One, if you are buying the option, that means you are giving away time value because that's going to decay when you hold it until expiration. And also because of that auto exercise and subsequent assignment that could occur. So that just means risk. There's more management that's required, but that's why that discipline strategy is ever so important.
Definitely. Thank you so much, Jessica. And maybe to add to that, if you ever have questions about what happens to your option at expiry, near expiry on a Friday, for example, highly recommend the audience check out our options FAQ on the Questrade learning side of the website. It's got, I believe, 10 questions that kind of answer the most common ones that come up around expiry as well.
And just to add on to both of those, one question was, are there any resources that we can recommend for super beginners? So yeah, this options can become complicated over time, but it can also be pretty simple when you're just starting off, but it does become a slippery slope. So if you're looking for just some very simple resources, you can see on the screen here, Questrade Basics, you'll see platform tutorials. This whole learning area actually has a lot of information for beginners. And as you can see, John's looking here, you'll see a lot of different option levels. It goes over introduction to options. So there's a lot of resources on the website. We can link to those as well. And just another question that I saw, do we have an example of when things may go bad? So yes, options, there is risk, as Jessica was saying. And I think an important thing to note is sometimes when you're trading, and if you have an option and it starts to go up, people sometimes wonder what happens with your contributions and the room that's in there. So it does go up with you, what's in your account as your account goes up. One other side to that is if you have an option and it does lose money in a registered account like a TFSA, that money that is lost is money that is not able to be put back into that registered account when the year, when it becomes a new year. So normally if you withdraw money from your account and then the new year comes, then you'd be able to put more money back into that registered account like the TFSA. However, if you lose that money due to trading and it goes to zero, or you just lost some money there, that money is not given back to you. That contribution space is not given back to you the next year. So you do have to be careful when doing some of these options in registered accounts. Non-registered accounts like a margin account, you don't have to worry about contribution space. So there's a lot of different strategies when you get into things like that, but that's just something to note when doing it in registered accounts.
Appreciate the extra context there. Thank you so much, Adam. So we've only got a couple of minutes left here, maybe about 5-6 for a few more questions. I apologize in advance. We won't be able to get through all of the open questions here. So let me just read through here. Maybe we've got one or two good ones.
I'd say one I'd love to answer.
Sure.
What do you mean by a secondary market? Even though that's, so it's terminology. That's just the stock market. Primary is IPO process. Secondary is it's handing between traders. I have a lovely analogy for that one. I'm so sorry it's girly, but nonetheless. But if you buy a dress or something directly from a department store, that's like your IPO process. Secondary is those secondary secondhand markets like Poshmark or Rebag or things like that. That is exchanged between people, and then there's supply and demand comes into play, and there's market mechanics, and that occurs mainly with the underlying security, but also options as well. So secondary market, long answer, but just literally means secondhand stock market.
That's a good one, and definitely a great explanation. I love the clothes analogy personally, so that works for me.
Thank you.
Maybe we've got one more here on, or a few more on how to identify American versus European options on the Questrade platform. And this one's actually an easy one. There's not going to be any symbol or special character. It basically comes down on what you're trading the option on. What's the underlying? So if it's an index, if the symbol ends in .in, so S&P 500, TSX 60, the NASDAQ, these indexes are all European style options. Whereas if you're buying a stock option or an ETF option, which does cause a lot of confusion, those are all American style options. So for example, even if you're buying an index-based ETF, just as an example, not a recommendation of a ticker symbol, but SPY or QQQ, these are ETFs that are kind of like indexes, if that makes sense. They track the index, but these are American style options. Versus if you actually buy the option on the S&P 500.im, that's in the European style option. Hopefully that makes sense. It kind of helps differentiate between the two. It's mostly a big difference if you're the seller as opposed to the buyer.
Yeah, I'd love to add to that if that's okay. You are unable to buy an index directly, but you can buy something that mirrors an index. So the main differences are the reason why American style are ETFs, which are mirrors of an index, they attempt to literally reflect the indexes or indices performance. They are American style because you can physically hold the stock or ETF, whereas European style, you can't. So that's why they're cash settled. You just get the value, meaning the up or down. And there is one question also about how can I use options trading for safety while buying an index fund for long term? Those are just very in the strategies. Today we talked about bullish buying and selling, but that's the beauty of options. And Tony will go deeper into this as well. But you can utilize options as hedging strategies. But remember, there's always a give and a take. That's what's important to think about with options, that if you've heard anything today, hopefully that would be one to take away, is the give and take with options and just making sure you put the give in your favor.
Just to continue off of that, similar to another question where it was asking about expiration dates. So one consideration, there's many different considerations when looking to choose your expiration date, but one just might be, remember with options, the benefit is that you have optionality. You have the choice to purchase the stock or to not. And so you're paying for that option and you have that contract for that. So having an expiration date further out sometimes can add time to put time on your side. And that gives you more optionality sometimes. But if you're, it depends on your strategy. Sometimes people do like to go shorter, as that can lead to different risk reward ratios. So a lot of the times it's good to think, how can I put optionality on my side so that you're able to put yourself in an area where you're not stressing too much as well, and where you just have the ability to choose what the best scenario is.
Thanks, Adam. And we're definitely going to dive much deeper into that in the second half of the presentation with Tony as well, when we're showing off the OptionsPlay platform. One of my favorite features is a sneak preview is the income generation tool, which kind of helps you select the most optimal strike price. So stay tuned. In about 5 minutes, we're going to kick things off. And unfortunately, that is all the time we have for the first part of the Q&A here today, before we move into the second half of today's event. Awesome. Welcome back, everyone. We hope you enjoyed the first half of today's event, and big thank you again to Jessica for explaining the ins and outs of cash secured puts and the wheel strategy. I'd like to welcome our next guest from OptionsPlay to the call, Tony Zhang. Tony is the Chief Strategy Officer and co-founder of OptionsPlay with over 16 years of experience as a market strategist in equities, FX, and derivatives. Over the last 10 years, he's built OptionsPlay into a global financial services data platform powering some of the world's largest banks, brokerages, wealth management firms, and global exchanges. You can also see Tony as a regular guest on TV, on CNBC's Options Actions show, where he and Jessica discuss popular options trading techniques and help demystify this crucial corner of the market. We're very excited to have him here to present the second half of our event today. And with that, I'd love to pass it off. Thanks again, Tony.
Thank you so much, Jonathan. Thank you so much to the entire Questrade team for putting on such a fantastic event. Thank you everyone for taking the time out here this afternoon. And again, thank you to Jessica for her first session and giving you a brief introduction to options as a concept, as well as conceptually the strategies that you might use to trade them in your portfolio. Now, what I want to do during the second half of today's session is to take what you've learned from a conceptual and theoretical perspective and really focus on the implementation part of it. How can you take what you've learned and apply it to the tools that you have access to at Questrade and make sure that you understand how to take the strategies that you've learned, analyze them, and execute them in your Questrade account. So what I'll do here is I will, start sharing my screen here. And what I want to do is I want to start off with a little bit around what you currently experience today. And then what I want to talk about is showing you the new tools that we have recently launched in partnership here at Questrade that will help automate some of the steps that are required to do the research, find these ideas, and then analyze them before you execute them in your portfolio. So let's start off by just taking a look at the options chains, because we're all, for any of you that are currently trading options, you're quite familiar with navigating the options chains. For those of you that are brand new to options trading, this is really where you will start your research whenever it comes to trading options. So for example, if you wanted to trade options on Apple, you would go to your options screen here on Questrade. And what this would give you is a selection of different expiration dates and different strike prices. And you can select different expiration dates, and within each expiration date, you can see a listing of different strike prices. Now, this is a limited number of strike prices of just 8 strike prices, but as you look at the options chains, you will actually see that there are sometimes dozens of strike prices, sometimes even hundreds of strike prices per expiration date. And this is really the challenge that you have when it comes to options, is that there are a lot of options. And in the last, call it 10 years or so, there's been a proliferation of expiration dates and strike prices that have been listed by the exchanges. Now, this can seem overwhelming initially at first, but it's actually a good thing because it means that you actually have a lot of options and you can really fine tune exactly what you're looking for. And these days, you can almost find exactly the expiration date and strike price that you would like to trade. It's very likely that there is an expiration date and strike price that's listed for you. It's just a matter of how do you navigate through pages that look like this to help you understand where do you want to start. Now, that's really where OptionsPlay comes in, because we have found that the process to select a specific expiration date and strike price typically is a systematic process, meaning if you have a specific view on the markets, if you're bullish on the markets, if you're bearish on the markets, if you're looking to generate income, such as using the wheel strategy that Jessica just presented to you, it all follows a process for how do you select an appropriate expiration date and strike price. So if it follows a process, our goal here at OptionsPlay is to try to help you automate as many steps of those processes as possible so that you don't have to remember how to do it and then actually go and do it yourself using a screen like this. Even though we can teach you how to do it, we can show you the process, we can walk you through it, and you can navigate your way through a page that looks like this. But from our perspective, looking at a page that looks like this is kind of like giving you the whole phone book and saying, go and figure out what number you want to call, versus these days, we don't use phone books for a reason. We simply search for what we want and the internet or tools provide us with what we need. So that's the same process that we want to take a look at with options. And if you go to the research tab on your Questrade, the first tab that has now been integrated into your Questrade account is OptionsPlay. And we built this tool from the ground up to try to help make your experience for trading options as simple as possible and remove that phone book experience. Well, basically what we want to do is we want to show you how to navigate, how to find the strategies that you want to trade, how to select expiration dates and strike prices that make sense based on what your views are. And the tool itself is divided into 3 sections. You have trade ideas and watch lists on the left-hand side of your screen. You have your security analysis panel here in the middle, and we have trading and income here on the right-hand side. And what I'm going to do here today is walk you through these 3 sections to help you understand how to utilize this tool to navigate finding ideas, making sure that you understand those ideas, and then more importantly, how do you select an option strategy to actually take advantage of your outlook and views here in the broader market. And what we'll do is we'll start backwards a little bit. We're going to start off with income, and then we'll work our way back to trading, simply because those are the strategies that Jessica laid out during the first session, and they do form the foundations for many of you, especially for those of you that are brand new to trading options. Income generating strategies forms the foundation of how do you utilize options to grow your account in the long run. Income generating strategies allow you to generate income in your portfolio that can help you sustainably and consistently grow your portfolio. Trading requires a different skill set with regards to understanding the outlooks of the market. So we'll cover that on the second part of the session. So as I said, the platform itself is divided into 3 sections. Trade ideas on the and watch list on the left-hand side. What you have are technical ideas that are scanned for you. You also have other technical screening tools within Questrade, so you probably are familiar with this, but you can basically create, you can filter this down into bullish or bearish filters, bullish or bearish ideas. There are also additional filters that you can add to the bullish or bearish ideas, and you can sort it based on the symbol, the price, the relative strength. I typically like to sort it based on relative strength, and this gives me a sense for what are the strongest stocks in the market that I might look at from a bullish perspective. And when I click on one, I'm able to find opportunities, that are currently trending higher, or vice versa. If I'm looking for bearish opportunities, I can use this tool to help me find bullish opportunities. So here is one that I found here on Verizon Communications. Recently, the trends turned positive, and perhaps this is the start of a bullish trend. But regardless how you want to look for ideas, whether you initiate them yourselves or you're looking for screening capabilities, our tools are designed to help you find that. And you can also set up your own watch list here within OptionsPlay. We have pre-built watch lists that are already designed for you here in OptionsPlay. So once you've found an idea that you're looking for, or found a symbol that you're looking for, all you have to do is type it into the section here in the middle, or you can simply click on one of these symbols here on the left-hand side. And when you do that, what we're trying to do is provide you with clear understanding of how the trend of a specific stock is currently playing out. As you can see at the bottom of your screen, you have trend indicators. And the idea of these trend indicators is to avoid the need to have to pull up a chart, add specific indicators to your chart, and then remember how to interpret those indicators day in and day out consistently so that you get a consistent reading with technical analysis. Now, I have been a market strategist for nearly 18 years, and I have seen just about every single possible charting package, charting setup, charting system that people have. And what I generally see for the most part is that most traders tend to be very inconsistent in their application of technical analysis. What I mean by that is that some days you choose to use a 50-day moving average, other days you choose to use a 200-day moving average, one day you use RSI, next day you use MACD, and you get an inconsistent result from technical analysis because we're never using the same indicators day in and day out, and many times we actually interpret the indicators differently depending on the day, and this is what we call confirmation bias. We basically have a view on the stock and we use the indicators to try to confirm our biases rather than using them as subjective ways to determine overall trend or momentum. So the reason that what we try to do here is boil down the indicators into interpretations for you. So the 1 month and 6 month trend is utilizing a moving averages to help you get a sense for what the moving averages are telling you from a short-term and long-term perspective. Now, because these are algorithms, they don't change from day in and day out. They don't change what period moving averages that we use. They don't change how they interpret the moving averages, meaning you get the same interpretation day in and day out from the same indicators. This means that you can compare any two stocks next to each other and get the same reading as to what are the moving averages telling you with regards to the trend. And this is incredibly important for traders who have a view, so you can type in any stock that you want and quickly get a sense for what is the moving averages telling you with regards to the overall trend. And no matter what symbols you change from stocks to ETFs, from US to Canadian symbols, you're going to get the consistent reading. And that's going to help you confirm a view that you might have, or perhaps tell you that a view that you might have may not be as the same view as you think. So this way, type in a symbol. Our tools will help you understand from a technical perspective, how is the trend doing from a performance perspective, as well as give you an update of what's currently going on with the most recent price action. So if something has broken above a major moving average, if it's gapped higher, if it's broken above or below a support and resistance level, this tool effectively updates you on those changes so that you get an idea of what's going on with the stock, as well as what's important from a price action perspective. And once you have that information, now you can form a view to potentially trade an option strategy on the back of it. Now, like I said, what we're going to do is we're going to work our way backwards. Instead of from trading, we're going to work our way backwards from income. So first, let's say that you own Apple stock, or if you want to own Apple stock. As Jessica laid out in the previous session, using the wheel strategy, you can use a cash secured put to acquire a stock that you potentially want to add to your long-term portfolio. And the benefits of that allow you to do so with a discount rather than placing a limit order. Or once you've owned that stock, generating income on the stock that you own, a fairly significant income relative to the dividend that you are potentially capturing from that stock investment, to increase the income potential of your portfolio. So what we're going to do is we're going to explore both opportunities and show you how the OptionsPlay tool automates that step for you, so that you can quickly identify where can you generate income, how much income can you generate, so that you can execute that trade quickly in your Questrade account. So in order to do so, what I'm going to do is I'm going to click on the income tab here at the upper right-hand corner of my OptionsPlay tool. And notice that throughout this entire experience, we do not present the entire options chain to you, because like I said, the options chain is kind of like the phone book. What you really want to do is know what number or which specific option in the phone book are you interested in, or rather makes sense from a starting point. And that's the goal here at OptionsPlay, is to give you a starting point that makes sense from a strategy perspective, from an expiration date perspective, and a strike price perspective. We're requiring minimal input from you before we present that to you, so that you can start learning, you can start exploring, you can start understanding before you can execute these trades in your portfolio. So when you click on the income tab, you're going to see two options. It's going to ask you, do you own shares of Apple? And obviously, if you don't own stocks of Apple, don't own shares of Apple, it's going to present to you that short cash secured put. And then if you do own shares of Apple, it's going to present that cover call to you. And the expiration date and strike price that's presented to you is going to be customizable by you as the user. So what I'm going to do is, before we actually look at any strategies and looking at the performance of these strategies, I want to walk you through how I set my settings specifically for cover calls and cash secured puts, which is, from my perspective, one of the more important things to do before you use the tool. So as you can see on the tool at the very bottom, there is a setting here called income settings. And this allows me to customize how far out in terms of expiration date do I like to go, and how aggressive or conservative do I want to be when I'm seeking these types of income generating strategies. And I can set them independently for cover calls as I do for cash secured puts. So for cover calls, I typically like to go about 45 to 60 days out with regards to my expiration date. So I typically choose a medium term time frame. And when it comes to risk tolerance, I prefer conservative, but I'm going to walk you through why these are my particular settings. And then for cash secured puts, I do the same thing. I typically go somewhere between short or medium. Let's go for medium for now. And for a cash secured puts, I typically like to go more aggressive when it comes to my risk tolerance. I'm going to walk you through why. And once you save these settings as default, any symbol that you type in, OptionsPlay will automatically seek the expiration date and strike price that meets your personal preferences. So mine, I walked you through what mine are, and now let's see why I choose these specific preferences. So let's say I'm looking at Meta platforms. Let's say this is a stock that I want to add to my long-term portfolio because I believe in the AI direction that they're heading in. I think that this is going to be a driver for revenue for them for the next few years, or perhaps even decade or so. And this is a stock that I think I want to add to my portfolio, but Meta is trading near a 52-week high. I'm certainly not I don't like to chase stocks at 52-week highs. I like to use strategies such as a cash secured put to try to generate some income and purchase this stock potentially at a discount. So the reason that when I use these types of strategies, I like to choose an aggressive strike price is because when you choose an aggressive strike price, what you're getting is a cash secured put that's relatively close to the current price of the stock. So just to help you understand, this is the medium-term time frame. And the options grid gives me a glimpse of the options chain, but it gives me a glimpse of reasonable starting points for different risk tolerances and different expiration dates. It's not going to give me the whole chain. It gives me something far more manageable for me to look at. So if we just start by looking at, let's say, the medium-term options going out about 60 days or so, and I'm looking at the January 19th expiration, as you can see, it's giving me three choices. I can use the 290 put, the 315 put, or the 325 put. So let's take a look at a chart here for Meta. So 325 would be giving me here. Maybe let's make this a little smaller. 325 would be a strike price that's around right here. That's just shy of the new 52-week high we recently made. 315 would be somewhere around here, and then 295 would be down here. So as Jessica was referring to before, these are the levels that the stock would need to be below on January 19th, the expiration date, in order for these trades to effectively execute and for the stock to be put to me. So when I think about placing a limit order, where would I theoretically place a limit order if I wanted to buy the stock? Now, if I placed a limit order very close to the stock that has a high probability of being filled, if I have placed a limit order down at 295, that has a much lower probability of being filled, which is why when I'm selecting strike prices for a cash secured put, I prefer the more aggressive approach because this gives me a much higher probability of actually owning the stock at the expiration date. And it has the added effect that the strike price is near the current price of the stock will generate the most amount of income. Now, let's put into context how much income there is. This is going to generate, in this particular case, $1,015 in income for me in order to buy 100 shares of Meta stock at an obligated price of $325. The stock's at $335. I'm obligated to buy it at $325. I'm obligated to specifically buy 100 shares of the stock at $325. Now, normally, if you place a limit order to buy 100 shares at $325, that's going to require $32,500 in cash, not including your commissions. But because I'm collecting $1,015, I actually only need, in this particular case, $31,485. Now, what's the difference between $32,500 and $31,485? It's actually a discount of 3.22%. Now, what I'm getting is a 3.22% discount on my stock purchase if the stock is below that 325 price by January 19th. And what I'm effectively doing is I'm owning the stock at a 3.2% discount. And from my perspective, that's a pretty significant discount versus if I place a limit order, I would get no income and I would get no discount on that stock purchase. So between the two options, I certainly would prefer to take that approach. Now, I just want to be very clear, a limit order and a cash secured put are not apples to apples. It's not a fair comparison to say a limit order is the same as a cash secured put because a limit order gets filled immediately when it hits your price. A cash secured put typically will only get filled if the stock is below your strike price at expiration. So I want to be very clear that there are differences, but the difference is the fact that I get a 3.22% discount on my cash secured put versus a limit order. And I'm willing to be patient to get that kind of cash, to get that discount, because even if the stock doesn't execute, meaning the stock is above 325 at expiration, at least I have something to show for my cash secured put. If I place a limit order at 325 and the order never gets filled, then I've effectively put away cash to basically place that limit order, but I'm not getting paid any yield on that cash. Here, I'm getting paid 3.22% yield in the next 66 days. And that's not 3.22% per year. That's 3.22% I'm getting paid in just the 66 days between now and expiration, which, if you annualize that out, comes out to be about a 19% yield on the cash that I've set aside in order to potentially purchase this stock. Think about that, 19% yield on a stock like Meta. This is not some super volatile biotech stock that you've never heard of. This is Meta. And I'll show you a few more examples of how much income you can generate. What most users don't quite realize is how much income you can potentially generate from these types of strategies. And even in the scenario where the order does not get filled, meaning the stock continues to take off and it never reaches the price that you want to purchase it for, you're not left not owning the stock with nothing. You're left with a 19% yield on the cash that you've set aside to purchase the stock. And like I said, this is Meta. Even though Meta is certainly one of the more volatile stocks in the S&P 500, it is not by any means the most volatile small cap biotech stock. These are mega cap names that you may own in your portfolio or may be interested in owning in your portfolio. And this is the amount of cash that you can potentially generate to try to acquire those stocks. Let me use another example, Alphabet. Let's say you really like Alphabet, again, also from their AI potential. Now, let's say you were looking to acquire this particular stock just by clicking on the income panel and selecting no, you do not own shares of Alphabet. It's going to present to you the January 19th 132.5 put. Like I said, we're selecting strike prices closer to the current price because that's going to increase our probability of actually owning the stock at expiration, and it has the intended effect of having the highest amount of discount relative to a cash secured put. And I will walk you through kind of what a more conservative view looks like as well. But let's take a look at Alphabet. Alphabet's currently trading just shy of 135. I'm going to sell, in this particular case, the January 132.5 puts. And what this tells me is that I'm going to be able to collect $345 in income. Now, if I were normally to buy 100 shares of Alphabet at 132.5, I would need to set aside $13,250, not including commissions, right? But in this particular case, I only have to set aside $12,905. That reflects the $345 discount. And how big of a discount is that? That's 2.67%. I'm going to generate a 2.67% discount on the purchase if the stock is below 132.5 by that January expiration date. That's going to be a nice discount on the stock purchase if this gets put to me. And in the case that it doesn't get put to me, I'm earning, in this particular case, a 15.7% yield on my cash. I know interest rates are high right now and you're getting a good yield on your savings account, but you're getting nowhere near a 15% yield on your savings account. And I'm not trying to compare a cash secured put to your savings account, to be very clear, but it gives you a good sense for how much yield this, even in an interest rate environment where you're getting 5% yield on your savings account, the yield that you're getting on the cash set aside to sell a cash secured put, if it doesn't get put to you, is significantly higher than that, just to help you give you a sense for the comparison in terms of how much yield could you be yielding, even in this particular case where the stock takes off and you don't get this cash secured put to you, you're getting a 15% yield on your cash, which you can then take that additional yield and apply to the next cash secured put. And you can do it over and over again. And once you find a trade that you're interested in, you can click on the preview button. And one of the great things that we've built in the partnership with Questrade is that you can simply click on this buy sell button here in the preview order button. And what it will do is it will pre-fill the ticket for you so that you can simply enter this trade for order execution. So as you can see, the current bid is 345. You click on that and it's going to be able to pre-fill your order. You can place your limit orders. I like to go somewhere around the midpoint. So between the bid and ask is 350. You could click on the sell button and preview the order button in order to enter this order into your trading account. So this way you can quickly find an opportunity using the OptionsPlay tool, analyze it within just a few clicks, because all of the relevant yield information that you need in order to make a trading decision is available to you without doing any further calculations like you do with the options chain. Not only do you have to find the expiration date and strike price manually, you have to calculate the yield manually. This tool does all of it for you so that you can quickly make that trading decision, click on the preview order button, and send this off for execution, which is within just a few seconds, rather than the minutes that it used to take me to do this research, which is why we created the platform to begin with. Okay. And like I said, I wanted to just also show you, give you a sense for it. What if you went more conservative, right? Let's say you went super conservative. You chose to do a 122.5 strike. So that's the strike price that's all the way down here. The stock has to be below that price by January expiration in order for it to be for the stock to be put to you. Here you get, in this particular case, instead of a 2.67% discount, you get a 0.94% discount. So you get a 1% discount. Not bad. You're still getting, I'll certainly take a 1% discount on every stock or ETF purchase if I could in the long run. That's going to have a pretty drastic effect in the long run if I can get a discount on every stock purchase. But as you can see, it's not a huge amount of cash, and your total annualized yield is about 5.3%. Roughly perhaps what you're getting in a high yield savings account these days in terms of yield. And you're generating, in this particular case, $114 worth of income versus the $345 that I'm getting in the more aggressive one, which is why when I'm selling a cash secured put, I like to select strike prices that are closer to the current price relative to the ones that are further away from the current price of the stock. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you as to why, when you're selecting a cash secured put, you want to choose strike prices that are relatively close to the current price of the stock. Type 1 into the chat window if that makes sense to you. And I just realized that I'm not sure that everyone has access to the chat window, so I will, let's leave that one for now. So let's now cover a cover call. Let's say you own these stocks in your portfolio. Now you're thinking about selling a cover call, just like Jessica laid out. How do you go about selecting the strike price that might make sense for selling a cover call? Let's go back to our income settings and make sure that we've got, like I said, I prefer the conservative setting when it comes to cover calls, and I'm going to walk you through why. Let's go back to that Meta example. Let's say you own Meta stock in your portfolio, and I think this is a stock that many of you may own in your portfolio. Remember, a cover call requires you to own at least 100 shares of the stock. And in this particular case, let me just adjust it to the medium term as well. In this particular case, what you want to do is you want to make sure that this is telling me to sell the January 19th 385 calls. Now that's a call option that's pretty far out of the money here. That's 385. That's all the way out here. That's, we're talking about a move that's more than close to 20% away from the current price of the stock. The stock would have to rally, in this particular case, nearly 20% between now and January expiration, which is only 2 months from now, in order for the stock to be called away. Why do I choose strike prices that are so far away? And this is a great question because a lot of times when you look at the options chains, I tend to find that a lot of people will tend to choose strike prices like the 355, the 360s. And, for just a comparison, if I chose the 355, I'm going to generate $925 worth of income. If I choose the 385s, I'm only going to generate $270 worth of income. Now, someone will say, why would you choose $270 worth of income when you could be generating $925 worth of income? And this is really where I have to remind you, selling cover calls, you're selling cover calls on stock that you own. Why do you own the stock that you own? You own it because you believe it's going to appreciate in value in the future. That's why you own the stock. Otherwise, you wouldn't own the stock. So what you need to prioritize when you're selling cover calls is not the income that you generate from the cover call, but the capital appreciation of your stock in the ETF. That's really where your biggest risk that you're taking is. To own 100 shares of Meta is $33,000. Your biggest risk is not in the cover call. Your biggest risk is in the stock that you own will decline in value. If it declines in value, you have thousands of dollars worth of risk. So in order to offset that risk that you're taking, you must have the appropriate upside to offset the risk that you're taking. So remember that when you're selling covered calls, the number one thing you have to first account for is capital appreciation. Income is secondary. So in this particular case, what I'm really doing here is I'm prioritizing instead of trying to generate $900 worth of income, I'm okay generating $270 worth of income, because if I can do that consistently month after month, what I'm really looking for are big months. Sometimes, earnings comes up, the market has a strong rally. And what you're able to do if you choose conservative strike prices is actually take advantage of most of that and be able to account for the capital appreciation. Because if the stock actually appreciates from 335 to 380, you're talking about, in this particular case, nearly $5,000 worth of upside. And what you gave up is nearly, probably $3,500 worth of that upside in exchange for about $600 worth of income, because that's the difference between 270 and 925, and you're giving up exactly the difference between 355 and 385 is $3,000 worth of capital appreciation in exchange for roughly $600 worth of income. And then that's an equation in the long run. If you keep giving up $3,000 of upside at a time in exchange for $600 of additional income each month or every 2 months, that is an equation that actually gives you a worse outcome when you prioritize the income versus the capital appreciation. So when you're selling cover calls, make sure that you use strike prices that are far away from the current price, where it almost seems ridiculous that the stock can reach that price in the short term. And the reason we do that is because once in a while the stock does. This says there's an 87% chance that the cover call that I sell will expire worthless. So there's an 87% chance that I keep the $270 worth of income. But that means there's about a 13% chance that the stock does make a big move, and meaning only about 1.5 out of 10 times will that happen. Nearly 1 out of 10 times will that happen. And in that 1 out of 10 times when the stock does make a big move, trust me, you're going to be kicking yourself for giving up $3,000 worth of income of upside in exchange for an extra $600 worth of income. That is an equation that does not work out for you in the long run. So when you're selling cover calls, remember, you want to prioritize capital appreciation of your stock over income. Accept a lower income level because you're still generating, in this particular case, 4.5% income on a stock that pays you 0 dividends. So if you own Meta, you're getting 0 income today. Here you're generating an additional 4.5% on Meta. And at the same time, if the stock does make a big rally, you can actually take profits on that big rally. And that's what you're trying to prioritize when it comes to cover calls. And just like a cash secured put, when you click on the preview button, once you've determined a cover call that you'd like to sell, you click on the buy sell, it's going to pre-populate the order ticket, and you can simply click on the bid price to start your order. I usually like to start around the mid price and send that off. If it doesn't get executed, I will kind of work my way towards the bid price, allowing me to try to get filled within a few, usually within 10, 15 seconds of me placing that order. And the idea is to basically go from a stock that you own, right? So let's type in another stock. Let's say you own 100 shares of Tesla and you want to sell a cover call on it. The goal is for me to get to exactly what expiration date and strike price within seconds, know how much yield I'm generating on this covered call, this particular case, nearly 8% yield on a stock that pays 0 dividends. I'm going to look at that and say that looks pretty attractive for me. Click on the preview order button, click on buy sell, and I can go from knowing that I want to sell a cover call to selling the cover call within seconds, as opposed to having to navigate that options chain, figure out where I want to start, do the manual calculations, and then enter my orders. So you can do this very, very quickly using the OptionsPlay tool, no matter what symbol you type in. Let's say, I'll pick one other stock here just for example purposes. Let's say you own 100 shares of Visa. You really like the stability of a stock like Visa, so you want to sell cover calls on it. It instantly tells you what expiration date, what strike price, how much yield you can potentially generate. In this particular case, not a lot of yield, 2.3%, but remember, Visa pays you 76 basis points per year. Here you're generating 2.3% per year. You're selling the cash secured put. So you're, in this particular case, tripling the dividend yield on that cover call. And if that sounds attractive enough to you, click on the preview order button, click on buy sell, and now you will have your order ticket to sell your cover call on Visa. So I spent a lot of time covering the income strategies that Jessica showed you here today, but I also want to make sure that for those of you that are currently trading options, especially for those that are trading directional views using options, I want to also walk you through how you can utilize the tool to find trading strategies. So, for example, let's go back to our Meta example. Meta just recently broke out to a new 52-week high. Let's say you believe the stock is going to continue moving higher. So how can you take advantage of that? Well, you can certainly buy 100 shares of a stock. You can look at buying a call option, or you can buy a call spread. All three strategies make sense as an opportunity to take a bullish view here in the underlying stock of Meta. Now, this is really what I meant in terms of our tool is designed to try to automate as many things for you as possible, because what we're doing here is we are basically saying, instead of picking the strategies yourself and having to pick an expiration date and strike price, we're going to do all of that work for you. We're going to present to you 3 of the most popular strategies to take a bullish view on Meta. And what we're going to do is select the expiration date and strike prices for you based on best practices for those individual strategies, so that you don't have to do it manually using the using the options chain. So what it does is it presents 3 strategies to you, and these are the 3 most popular strategies that you might use to take a bullish view here on Meta. And what it presents to you is the trade cost of each strategy, and it allows you to compare each strategy side by side. So you can say, well, what happens if Meta doesn't go in the direction I expect it to? How much potential loss do I have on each one of these 3 strategies? And what if it does go in the direction I expect it to? How much potential profit do I have on each one of these strategies? And it allows you to compare it side by side and actually see which one is going to present you with the best outcome based on what outlook you might have on the individual stock. And you can do this for bullish strategies, and you can also do it for bearish strategies. So for any stock that you are plugging in, you can say, I'm bullish, I'm bearish, and instantly see what strategies make sense, what expiration dates and what strike prices are good starting points for those strategies, so that you can start learning, start researching, start analyzing before you can make that educated decision as to which strategy you might want to trade in your own portfolio.
Thank you again for the presentation so far. I'm just taking a look here through all the questions that have been rolling in, and really appreciate the engagement so far from the audience. Thank you again. Let's see here. So we're definitely going to get into some of the OptionsPlay scores and things like that momentarily. Let's see here. Maybe a quick general question here about, can I lose my collateral if the contract expired? So this one's generally referring to when you're going long on an option contract. And if the contract expires worthless, your collateral is fine. So basically, if the option is not exercised, it's not a sign, whatever collateral you put up, whether that's cash, if you're doing a cash secured put, or if it's a covered call and those are shares, that collateral, nothing happens to it basically if the contract expires worthless. That way you're able to sell another covered call or another cash secured put potentially in the future. So hopefully that helps answer that question a little bit about collateral. Adam, do you see anything good here?
I actually just wanted to mention for anybody who's wondering, I did see a question earlier on, but Tony right now is using the Questrade Edge web platform. So if that's what you were looking to do what Tony's doing here, you could head to that platform. You'll see exactly the screen when you get to the research area. And also, I saw a question about do you need to own 100 shares of the stock to do options? So that is for things like covered calls, covered puts, where you have to have at least 100 shares to enter in strategies like that. However, not all options require you to own shares beforehand. So it can change depending on what your strategy is. So that's one of the things where you can look into, and with the help of OptionsPlay, look at some of the different strategies. You'll see what is required to be able to enter into that trade. So not all need for you to own shares.
Perfect. Thanks for shedding some light on that, Adam. Definitely. Okay. Got a couple of questions here, maybe for some people that just joining a little late, but don't worry, the on-demand version will be available next week. So you can always catch the recording, slow it down, speed it up. I know it's a 2-hour-long webinar, so it does require a lot of attention span. And the question is, how do I get to this screen? So this is the Questrade Edge web platform, and it's a new OptionsPlay research platform that's built in. Just bear with me one moment here. I'm going to take over the screen share here and jump into how we can get here. So my screen share should be visible for everybody now. So when you first log into Questrade, most likely you're going to be on the account screen here if you're using a web browser. And to get over to Questrade Edge Web, if you already have Edge Web enabled, you simply click the Accounts button and then Questrade Edge Web. Now, if you haven't traded with Edge before, if you're only used to the simpler investors platform, you do have to go to the All Platforms tab. Then click Questrade Edge up here. Then if you haven't added Edge, you're going to see a green button here that says Add Questrade Edge. Once you click that button, it's free, and you can jump right into using Questrade Edge Web, desktop, or even the mobile browser. Please note, at this time of the webinar, OptionsPlay is only available for Edge Web, but stay tuned. In a couple of weeks, we should have it ready for Edge Desktop and maybe some more news in the new year as well. So if you do have if you do have Questrade Edge Web enabled, you simply jump back over here. And then OptionsPlay is going to be located under the Research tab here on the left, and it's the very first tab. Now, if it's your first time opening up OptionsPlay, you will have to agree to a quick disclaimer, and then the page is going to load here in just a moment. Please give your browser about 10-20 seconds to load if it's your very first time launching OptionsPlay.
I can actually jump on to one question that I saw here earlier.
Sure.
So for the options trading, when you're doing options trading, the commission that you're looking at is going to be $9.95. It's $1 per contract, and you will be charged in the currency that you're trading in. So if you have American dollars and you're looking to make a USD, trade, it'll be done in USD, and if it's in Canadian dollars, it'll be charged in Canadian dollars. So it's not going to forcefully convert from the other account or from the other balance. And for more information on that, again, you can head on to our website. You'll see we're under the commissions and fees section. You can also just search trading fees. You'll see a lot of information about all the fees, and including active trader fees. So another question was about somebody who trades daily. Yes, there are active trader pricing, so that if you trade often, you can actually get a discount on how much your commission is on the options and stocks as well, and other things there too. So definitely head to that section. Again, you can search on Questrade for trading fees, and you'll find a lot of information on that.
Thank you so much, Adam. Really appreciate that extra clarity around there. I know a lot of questions has come up. Maybe another quick one that I can help answer, and is OptionsPlay an extra cost? The great news is it's absolutely free for all Questrade customers. So it doesn't cost anything per month. There's no subscription. Normally, OptionsPlay, standalone, if you went to their website and signed up for their platform, close to $100 US per month. So with this amazing partnership with Jessica, Tony, and the whole squad over there, we've managed to provide this service completely free of charge to all Questrade customers. So highly recommend everybody on the call take advantage and take a peek. I'm sure you're going to like what you see. Not sure, Jessica, if you're able to help answer this one. I personally have a question about this, and I know it's come up once or twice here in the Q&A. And are you able to shed any light on the OptionsPlay score? So whether it's one of the trade ideas here, or if I search for my own symbol, what's kind of the difference between maybe a red score, orange, and then something green with the OptionsPlay logo?
Sure. So that is where we'll answer where a part of that is proprietary, but there is, it's great to get some information as to where it's comprised from and what it's looking for. So it's actually on a scale all the way up to 200. I've hardly seen anything go to 200, but the general rule is if it's over 100, that's going to turn green, and it's focused on risk versus reward. So what it takes into account is if you click that and it switches over for the profit and return right there. So you've got your cost, max reward, probability of profit, days until expiration. It's taking everything into account and saying that your risk versus reward is ideal or not. So the rule of thumb is if it's over 100, then that is a good risk versus reward. If it's under, then you'll notice it'll start turning orange for a little cautious, and then red for oop. So that just means it's taking everything that you're looking at. Visually, you'll notice throughout the entire platform, things turn red, green, or yellow because OptionsPlay was founded on taking all of this complex data and making it easy to understand and consume. So that's the same intent there. It's just focusing on risk versus reward, and that's inclusive of probability of profit. And that strategy has ideal based off of those mechanics.
Fantastic. Thank you so much, Jessica. And I personally love the color coding. I think there's so much information overload for most of us as traders. We've all got multiple screens open. Color coding just makes it easy. You know, you look at it, okay, maybe I'll avoid this one. Maybe this is one I'll consider. And then you can take a closer look and kind of preview the trade, see if it meets your own personal risk tolerance and everything like that. I see a question here about multi-leg option strategies with OptionsPlay, and thank you. This has been a great webinar. Appreciate the feedback, and I'm glad you're liking it so far. You can perform multi-leg strategies. So as an example here, one of the, let me zoom in because this text might be a tiny bit small as I'm sharing my screen. This here is actually a vertical call. So this involves two different options contracts that are combined into a multi-leg strategy. And technically a covered call could be considered multi-leg as well if you're buying the shares at the same time, if you don't already own your shares. So OptionsPlay definitely does support multi-leg options trading and all the advanced options things you might need here. Jessica, I'm not sure if you'd maybe be able to answer this one, and that's, will a feature be added to OptionsPlay to factor in commission costs as well, potentially maybe next year as a longer-term roadmap? Do you know anything about that?
We don't have any plans for that, but at OptionsPlay, we've got some great developers and can do anything. So we'll take that as feedback.
Definitely. Maybe next year, we'll see. Thank you so much. And do we have the currency option for trading is a question here. I believe this is more of a general question for Questrade. So if you're trading a Canadian option, specifically your Canadian stock, you're going to be paying Canadian dollars from your account. So you'll see the little Canadian flag here versus American, you'll see the American flag. Now, if you go back to your account page here in Questrade EdgeWeb, you'll be able to see your currencies separated into individual CAD and USD columns, as well as an all-in CAD and all-in USD approximate column. So this shows if you were to convert all your funds to one currency. One thing to keep in mind is in a margin account, you can borrow funds to invest. So keep an eye on your cash. In this case, I'm actually borrowing about $70 US and using some margin right now. So if you don't have enough cash available, you may want to convert that either after your trade or before your trade. It's up to you. So generally, all of your trades are done in the currency of the transaction. All right, maybe we'll finish off with one or two more here. Adam, do you see anything good? Or Jessica, anything that we'd want to tackle maybe before we wrap things up?
I do see one, and with the help of maybe you guys, we can answer this. There's just a question. Yes, maybe you've covered this a little bit, but this seminar is extremely helpful. It's great to hear. Definitely a lot of great information is being covered. So thank you again to Jessica and Tony. But the question was about essentially future resources. Will there be more of this and just general resources on OptionsPlay with Questrade? So there will be a lot more resources coming forward in many different formats, sessions in the future when it comes to webinar such as this. I'm not 100% sure on how many of these we will be going through, but we do have a lot of resources online, as you see on the screen here. And so yeah, there's endless amounts of ways to get more information on Questrade, on OptionsPlay, and more coming about the connection between the two as well.
Absolutely.
Thanks so much, Adam. Yeah, in the meantime, I was just pulling up OptionsPlay YouTube channel. I personally love this channel. Jessica and Tony are always coming on, giving great videos, and whether you're a beginner or a pro, I'm sure you guys are going to find something great here. Also, feel free to check out our webinars from last year with Tony and Jessica. More theory-based, less practical, but you can definitely still learn a thing or two there before you dive into the world of options trading.
Yeah, did a lot on the basics. So the questions from earlier, where do I learn more? That was got a good 4 hours of content there to learn the basics.
Definitely. Maybe we'll include a link to that in the on-demand email as well next week. So if anyone's interested in some of the webinars from last year, we'll add a link in your email there so it's easy to find and you don't have to go digging for it.
Mm-hmm.
And yeah, maybe just the last question here for you, Jessica. Does OptionsPlay have any other additional resources, maybe on the website? Is there a newsletter I can subscribe to or anything like that to maybe catch a little bit more of you and Tony and the rest of the gang over there?
Yeah, so OptionsPlay. So one, the beauty of OptionsPlay being integrated into Questrade is that's going to be free to you as a Questrade client. Know that OptionsPlay does have a membership fee. Our education is free though. We host them every Thursday at 4:15 p.m. Eastern time. Tony and I alternate each month on the topics that we cover. And it's usually always user-based. So depending on what our community wants, we will give. But what comes with our OptionsPlay membership is you do get regular macro overview. There are daily trade ideas that are there. So we do take it a little bit of a step further, but know that there is a fee there. But there is also a 30-day free trial that you're more than welcome to try. And you can always follow us on our social channels. We're education centric. So we have a lot of free content that we'll find on our social. You'll catch us on the media quite often, and we'll tend to post it there. So there's a lot to certainly cover.
Perfect. Thank you so much, Jessica. And hopefully some of the people on the call take advantage of these additional resources. I personally love the upcoming events. You can always kind of see what's happening at a glance. And a lot of these events are still free. So definitely take a peek, guys. With that, I think we will slowly wrap up here. One last topic I quickly wanted to cover for everyone that has come up once or twice in the Q&A is the equity requirements and what type of account you need to trade certain types of option strategies. So options trading at Questrade and generally at most Canadian brokers is organized into options levels by complexity. So level 1 is going to be your simple long calls and puts. Level 2, covered calls and puts, starting to get a little bit more advanced. Spreads, those multi-leg options, vertical spreads, calendar spreads, anything like that. And then you've got all the way at level 4, which is uncovered calls and puts. So when you don't have the collateral put up, and these can be a little bit more risky. So if anyone's curious, I'd recommend checking out the options levels article on the Questrade learning site. And this actually has every single option strategy organized by level and kind of what type of account you might need to trade it with. Generally, only level 1 and 2 strategies are available at registered accounts. So that's your tax-free savings account, your registered retirement savings plan, your first home savings account. You can only trade level 1 and 2 strategies. Whereas in a margin account, there's no special tax privileges, so there's no additional rules either. So you can trade anything. Hopefully that helps. All right. And with that, I think we will wrap things up. Thank you so much again, Jessica. We really, really appreciate your time. And thank you to Tony as well, who unfortunately couldn't stay for the whole session. Thank you, Adam, for your great help with co-hosting. And thank you to the audience for your engaging questions. Keep an eye on your browser for the post-webinar survey. We'd love to hear your feedback. Thank you again, everyone, and have a great afternoon.
Thank you.